And since today's show is about successful real estate, I thought I would talk about successful financing. And the topic is going to be on the pre-approval process. So there's a lot of nightmare stories that you hear about the pre-approval process. So I wanted to give you some advice on how to make this process go smoothly. Now, you might be asking, how can you have a bad experience during the pre-approval process? Nothing's really happening. You're not shopping for a home. You're not closing on a home. Well, how you can have a bad experience during the pre-approval process is when you go to shop for a home, your pre-approval does not go through or your financing falls apart. Now, it's important to understand what pre-approval means. Pre-approval is a solid loan commitment from a lender. Going through underwriting, verifying all your income, your assets, everything's getting verified and then determined based on what you can actually pre-approve for. But it is a pre-approval. Pre-approval meaning it's subject to all of this information being verified at the time that you secure and move forward during the closing process. So here's something you want to remember is you don't want to make any changes to employment, income, assets, liability, or credit. So income, employment, income, assets, liability, or credit. The information is based on, your pre-approval is based on the information that's provided at loan application. So yes, if you make any changes to employment, income, assets, liability, or credit, it can definitely affect your pre-approval, maybe making an adjustment to the amount that you can pre-approve for, or completely eliminating the ability to be able to get financing based on something that you've done. Now, a lot of times you can make changes in your current financial situation that you cannot repair, and you're in a position not to move forward and purchase and close on that home. So a takeaway from this is just to make sure that you're communicating with your mortgage and consultant to make sure before you make changes on how it's going to affect your actual pre-approval. Now, let's go ahead and break some of these things down. Let's talk about employment. So employment might be that you're currently working for as an actual employee right now. And let's just say that you're a software developer, software engineer. I think there's a few of you that might be listening that are software engineer. Now, there's a lot of opportunities in that arena to do contract work. Now, as a contractor, you actually may make a higher income than actually being an employee for, let's just say, through Microsoft. The problem is if you don't have a history of working contract work for at least minimum 2 years, you don't have an income to use. There's nothing to average over that 2-year period of time. You have to have a history of receiving that income. So what you've done is you've taken yourself from a position to where you're pre-approving at, I don't know, maybe $100,000, $120,000 a year to not having any income at all. So unless you can put yourself back in a full-time position at a company, your financing is no longer going to go through. So a simple conversation would be to pick up the phone and find out. And here's what you need to do is just strategize on your timing. Once you own a home and you have closed on that mortgage, you can do anything you want with your personal financial situation. As long as you make your mortgage payment, nothing's going to happen to that loan. It's anything before you actually close and secure that loan and move into your home. So second is income. Now, income can be, tricky as well if you don't understand how the financial arena works. Again, let's use this same example, but with a little different spin on it. Let's say that you are an employee that gets a guaranteed salary and you're making $60,000 a year. And now let's say you're not changing employment or employers, you're going to stay at the same employer, but you're actually taking on a different position, a better position, meaning that in this situation, better meaning a higher potential of income. So you think by advancing into this new position, your income is going up, you're with the same employer, how would anything change in a negative fashion? Well, if that is not a guaranteed salary position, but instead, well, maybe it's a guaranteed salary, but it's a small salary. So you're going to get $30,000 base salary, and then you're going to be making commissions on top of it. Now, not only are you know that you're going to be making commissions, but they actually have documentation to show you how much other people in that sales position, and maybe even conservative people in that sales position, are making in commission. And you look at the difference between that commission potential. Even with that low base salary, it's going to be a lot more than what you were doing at a $60,000 base salary. It doesn't matter because you don't have a history of receiving commission income for 2 years. So without that 2-year history, the only income that's going to be utilized to approve you for your mortgage now is your new $30,000 base. So you just cut your income in half for approval. This can be devastating in the process of securing your financing when you actually find a home. So here's on income. Anything that's not guaranteed, they want to see a history for 2 years. If you're a salary employee, you're making $30,000 today and you move to another position after consulting with your mortgage consultant to make sure everything's going to be okay, and you have an increase to $60,000, you're going to get qualified based at $60,000 income because it's a guaranteed salary. It's things that are not guaranteed. Commission, overtime. You can't go take on a part-time job, and if you don't have a history of working 2 part-time jobs, you can't use that additional income. Opening a business, you can't use business income unless you have a history of receiving that income. Bonus income can't be used unless you have a history of bonus income. And just in positions in getting signing bonuses, or Amazon's got a lot of creative ways to pay coming in new employment into Amazon to where you're getting stock for part of your salary. That can't be used unless you have a history of actually showing that you've been cashing and liquidating that stock. So if it's a little bit confusing how financing works, it's okay. That's why you have a mortgage professional there to walk you through the process. It's just understanding you want to be communicating with them with any of these changes that might come up from the time that you get pre-approved all the way till the time that you actually physically close on that home loan. Now, down payment or assets. So assets, one of it being down payment. If you are letting your mortgage consultant know that your down payment is coming from one source, let's say money in your bank, or let's say gift funds from a family member, that's acceptable on almost all loans. You just want to communicate if that's going to be changing as far as your gift. What if you decide that you're going to change to borrow from a credit card? Well, that's not okay. And a question that a lot of times you may ask is, well, why does it really matter where the money comes from? I've got the money. I'm going to provide the money. It does matter. Everything has to be verified where those funds are coming from. So communicate as far as your down payment if you make changes. Reserves. You may not even know that your pre-approval was based on the fact that you had 12 months in reserves for mortgage payments. Now, your traditional loan wants 2 months of mortgage payments left over after closing. You don't have to It's not coming into the bank, but you have to have it in order to close. FHA, you don't need any, but there are loans that require 6 months, 12 months of reserves. If you're making any changes to the money that you have left over after closing, I know it may not make sense, but it could have a big impact on your loan. So check with your mortgage consultant first before you go spend that money. Deposits into your account, any deposits that can't directly be verified from payroll, money coming from the IRS, something that can be paper trailed. Cash is a bad thing. You don't want to be depositing cash in your bank account unless you can paper trail and verify back, which it's kind of hard to do that on cash. So any changes on your assets, check with your mortgage consultant. Liabilities, obviously, in purchasing anything new from what you originally had at your debt is going to affect your approval. It's going to affect it dollar for dollar. So if you get a new car payment for $500 a month, now you pre-approve for $500 a month, less than a mortgage payment. Huge impact on your buying potential. Credit, all I can say is credit, don't make any changes. I'm going to leave you hanging a little bit here because I've got to take us to commercial, but you would think paying off collection would be a good thing. Let me tell you, paying off collections accounts can be devastating to your credit score, and you cannot replace that. You can't fix that once you've done it. So call me if you have any questions. If you're in the middle of buying and you've got any challenges, that's really what the Money Hour is all about. It's here to help you in any area regarding your finances. I happen to be the expert on mortgages, so if you need my assistance, please call into the show, 1-855-400-1150, or online at themoneyhour.com. Coming up next on The Money Hour, we're here to not talk about nightmare real estate stories, but we're here to talk about success real estate stories. Sandy Tampa and Aaron Hoppy with Windermere Bellevue Commons right here on 1150 AM KKNW after the short break.